morning. Today we are going to talk about national account. As we said before, the GDP or gross domestic product is defined as the market value of all final goods and services produced in a country during a specific period of time, usually 1 year. GDP can be measured using two different approaches. Flow of product approach or known as expenditure approach, and flow of cost approach or known as income approach. According to flow of products approach, GDP is calculated as C plus I plus G plus X minus M. As we said before, that the country consists of four main sectors: households, businessmen, government, and the rest of the world, all interaction with other countries in the world. Spending made by each one of them has different name. So spending by household on goods and services, this is known as consumption expenditure. So this is spending on goods and services by household. It's known as consumption expenditure. Spending on goods and services by businessmen is known as investment. So I stands for investment, which is spending on goods and services by businessmen. Spending on goods and services by government is known as government expenditure. So G stands for government expenditure. Which is spending on goods and services by government. What about X and M? X is export, which means selling of goods and services to the rest of the world, while M stands for imports, which means buying of goods and services from the rest of the world. X minus M is known as NX or net export. So GDP, according to flow of product approach, is measured as consumption expenditure plus investment expenditure plus government expenditure plus net exports, or X minus M, exports minus imports. What are the items that are not included in GDP? Number one, used goods. If you would like to buy a used car, this used car was produced many years ago. Say, for example, I would like to buy a car produced 2019. Engie will buy this car in 2021. So this car has been calculated in GDP of year 2019, but this is considered to be reselling of previously produced products. So it will not be calculated in GDP of 2021. Okay, so this is number one. Number two, buying and selling of securities. Securities means bond and stock. Bond and stock are financial assets. They are not a physical one. So this means that there is no actual production for a product. Okay, in case of financial assets, we are not going to produce a physical asset or a product. So selling and buying of securities will not be included in GDP. Number three, transfer payments. Transfer payments like grants or donation. Grants or donation. You are going to get money without exchange for any product, any good or service. So there is no actual production in this case, and this will not be included in G, and hence will not be included in GDP. Number four, interest on government loans. On government debt. Interest on government debt or government loans is not accompanied by actual production of goods and services. So this will not be included in G or government expenditure, and hence will not be included in GDP. So both of them will not be included. In G and in GDP as well. If you are going to deduct depreciation from GDP, this is known as net national product. So net national. Net national product, or known as NDP, is calculated as GDP minus depreciation. If you are going to deduct indirect tax from NDP, you are going to get national income. National income is calculated as NDP minus indirect tax. Or we can calculate national income as return to factors of production. As we said before, that we have four factors of production: land, labor, capital, and entrepreneurship. Land earns rents, labor earns wages, capital earns interest, and finally, entrepreneurship earns profits. So, national income can be calculated as rent plus wage plus interest plus profits. If you are going to deduct direct tax and net business savings and add transfer payments to national income, you are going to get disposable income. Disposable income is what people spend on consumption and savings. So this is the actual money received by household after deduction of taxes. So disposable income is calculated as national income minus direct tax minus net business savings plus transfer payments. And for simplicity, we are going to assume that net business savings and transfer payments equal 0. This is just for simplicity. So once again, if you would like to calculate GDP using flow of product approach, it's calculated as C plus I plus G plus X minus M. If you are going to deduct depreciation, this is known as net domestic product. If you are going to remove indirect tax, this will be national income. If you are going to deduct direct tax and direct tax and net business savings and add transfer payments, this will be disposable income. What is the difference between GDP and GNP, or gross domestic product and the gross national product? As we said before, that GDP is the market value of all final goods and services produced within the country or within the country's border, while gross national product is the market value of all final goods and services produced by domestic factors of production. Whatever their location. So if we have two citizens, two individuals, NG, which is an Egyptian worker, and Google, which is an American one. Both of them live in Egypt. And Nino, which is an Egyptian worker, and he lives in United States. If you would like to calculate GDP, so production made by NG and Google will be calculated in GDP, as both of them located inside Egypt. It is production within the country. But production of Nino will not be calculated in GDP. What about GNP? If you would like to calculate GNP, production of Nino and Google will be included. Sorry, Nino and NG. NG and Nino will be included in GNP, while production of Google will not be included in GNP. So the difference between GDP and GNP is the location of production. So we can calculate GNP as GDP plus net income from abroad. Net income from abroad is calculated as the difference between income received from abroad and income paid or flowing abroad. So net income from abroad is the difference between inflows of money and outflows of money. If you are going to deduct depreciation from GNP, you will get net national product which is calculated as net domestic GNP or gross national product minus depreciation. For example, let's take an example. Requirement number 1 is to calculate GDP. GDP is calculated as C plus I plus G plus X minus M. So consumption 2000 plus investment 3000 plus government spending, which is 4000 plus export 1000 minus imports 1500. So GDP equals 8500. Requirement number 2 is to calculate net domestic product. Net domestic product is calculated as GDP minus depreciation. So it's 1500 minus depreciation, which is 500. So net domestic product is 8000. Requirement number 3 is to calculate national income. National income can be calculated using 2 different methods. Number 1, net domestic product minus indirect tax, which is 8000 minus indirect tax 300, so it's 7,700, or it can be calculated as rent plus wage plus interest plus profits. Wage, rent, interest, and the profits. It will be 7,700. Finally, the last one is to calculate disposable income. Disposable income is calculated as national income minus direct tax minus net business savings plus transfer payments, and actually you assume that both of them equal 0, so it will be 7,700 minus direct tax, which is 150. So disposable income is 7,550. This is the calculation of GDP using flow of product approach. What about the flow of cost or income or earning approach? According to flow of cost or flow of earnings, it is a summation of all costs of doing the business. So it is a summation of wages paid for workers plus rent plus interest plus profits. So this is the national income, and then you have to pay depreciation in order to be net domestic product, and then you have to add indirect tax to get the gross domestic product. As we said that GDP means the market value of all final goods and services. Why do we have to add the final goods and services? We use the word final in the definition in order to avoid double counting. So this means that we have two different types of goods, either final goods or intermediate goods. Actually, it is going to be counted in GDP is final goods only. Intermediate goods will not be counted. Why? In order not to count them twice. So, what's the difference between final and intermediate goods? Final goods are goods that will be consumed by the final consumer, while intermediate goods will be used in the production of another product. So, say for example, tomato. Is it a final or intermediate good? This is based on who buys this product. If I'm going to eat it, so this is a final good. If I'm going to use it in the production of another product, such as pizza, for example, so this is, in this case, it's an intermediate good. So it will be counted in GDP if it's a final product, and it will not gonna be counted if it's gonna be used in the production of pizza, for example. So this means that if you are going to calculate GDP, you have to calculate the value added, or the difference between the firm's sales and the cost of intermediate good, and this is the addition to production. So say for example, we are going to divide the production process of bread into number of stages. So this is stages of production and sales receipt or selling price, and this is cost of intermediate goods, and finally the value added at each stage. First of all, we are going to plant wheat. This wheat will be sold in the market for $24, for example. Cost of intermediate good in this case is 0. So the value added in the first stage of production is 24, which is the difference between sales receipt and cost of intermediate goods. We have converted this wheat to flour. So the factory that produces flour is going to sell flour for 33 in the market. But they have to pay the price of the wheat, which is 24. So the value added in this stage of production is 9. This flour has been converted to baked dough. Which will be sold in the market for $60. But the firm has to pay 33, which is the price of the flour. So in this stage of production, the value added will be 27. And finally, it will be baked and we get the bread. The bread will be sold in the market for 90. But the bread maker pays 60 for the intermediate goods. So the value added in this case is 30. If you are going to add the value added in each stage, it will be 90, which is the summation of the price of the bread sold in the market. So the summation of value added should be equivalent to the price of the product, of the final product sold in the market. This is the end of our lecture today. Thank you and see you next week.